Imagine checking your digital paycheck on a Friday morning and realizing the federal government took absolutely nothing. No annual filing, no deductions. President Donald Trump has repeatedly suggested that the United States should eliminate the income tax and return to the economic system that existed before 1913. From roughly 1870 until 1913, the federal government relied primarily on import tariffs. There was no permanent federal income tax, and the U.S. dollar was backed by physical gold. Returning to a purely tariff-based system is a massive undertaking. Applying a 19th century revenue model to the modern federal government creates an immediate mathematical crisis. In 1910, the U.S. government operated on about $24 billion in today's dollars. Today, the federal budget exceeds $7 trillion, funded almost entirely by taxpayers. Taxes generate over 80% of revenue, while tariffs account for a tiny fraction. Even extreme, sweeping increases in global tariffs would fall short. The sheer volume of international trade cannot generate the trillions of dollars required to maintain current government programs. If the income tax were eliminated, tariffs alone would leave a multi-trillion-dollar hole in the budget. Balancing that equation requires a significant change in how the government accounts for its own wealth. To bridge a gap of this magnitude, some analysts point to a mechanism used during past economic transitions, the official revaluation of national gold reserves. To understand the logic, we have to look at the events of 1913. That year saw the creation of the Federal Reserve and the dawn of the income tax, moving the United States away from hard money and into a credit-based economy. A credit-based system allows government spending to expand without the strict limits of physical gold reserves. But to finance that expanding debt, the continuous collection of income taxes became necessary to service the interest. Exiting this cycle of debt and ending the income tax would require the government to pivot back to a hard asset framework. The government doesn't need to physically mine more metal to create wealth from gold. It can simply change the asset's official paper value. In 1934, President Franklin Roosevelt did exactly this. By decree, he raised the official price of gold from $20.67 to $35 an ounce. The stacks of physical gold sitting in the Treasury vaults didn't grow, but by assigning a higher price per ounce, the U.S. government expanded its wealth and strengthened its balance sheet overnight. This diagram demonstrates how that mechanism applies to today. The United States owns over 8,000 metric tons of gold. Repricing those reserves to $50,000 or $100,000 an ounce would cause the relative burden of the national debt to shrink. This is known as partial backing. It doesn't lock the economy into a rigid one-to-one gold standard. Instead, the revalued gold acts as a foundational floor, providing stability while still allowing for credit expansion when necessary. A massive upward revaluation of gold is the only mathematical tool capable of neutralizing sovereign debt and making the income tax obsolete. This shift extends far beyond domestic U.S. politics. Evidence suggests the groundwork for a transition away from pure fiat currency is already being laid by global financial institutions. Central banks worldwide are currently hoarding physical gold at record-breaking historic levels, accumulating massive amounts of metal in their vaults. Furthermore, the Bank for International Settlements recently reclassified physical gold as a Tier 1 banking asset. This designation places the safety of gold on par with holding cash. Institutions return to gold during major economic transitions for a specific reason. Unlike paper currency, physical gold carries zero counterparty risk. Its value does not rely on another country's promise to pay its debts. When political leaders propose replacing taxes with tariffs, they are signaling a macroeconomic shift. The math requires a massive offset to function, and gold is the historic candidate for that role. The pure fiat experiment is reaching its mathematical limit. History shows that when monetary resets arrive to clear the slate, they rarely ask for public permission. They simply happen.